Well, good morning, everybody, and good afternoon, depending on where you are in the country. Thank you so much for taking a few minutes out of your day to join Blake and myself here at Miracle Mile Advisors as we dive into a topic that is, you probably were thinking you were just getting past with tax day coming and going on April 15th. But we thought this would be an opportune time for us to actually leverage the fact that taxes have still been on people's minds and or you filed an extension and it's something that's coming down the road later this fall to talk a little bit about upcoming changes relative to the estate and gift tax here in the next 18 to 24 months. And so before diving in, I thought it would be a good thing for us to introduce a couple of things to you. Uh, First and foremost, want to thank you for your partnership, for your trust in Miracle Mile Advisors, and most importantly, that deep relationship that you have with your client advisor. And so it is an honor and a privilege to be on the team here. My name is Nate Angelo. I am the head of wealth management, and really, in a very simple form, that means that I am focused on the client and advisor relationship, ensuring that we continue to deepen our areas of expertise, ensuring that our advisors are embracing the capabilities that we are bringing forth to really help you navigate life. And we know that it is a special place that you have invited us into as it is in your life, as we work with you, not only through the needs that you may have financially, but helping you navigate a plan, and then ultimately helping you navigate the unplanned, as we know that life throws us curveballs and creates both opportunities and challenges, where having a partner to work through those things is super important. And so thank you for your time. And I will introduce Blake in just a moment, but I thought I'd take a couple of minutes just to quickly unpack some of the capabilities we have here at Miracle Mile Advisors to ensure that you are up to speed with some of the things that we've added in terms of capability set. And so this probably comes to no surprise to any of you that are on this webinar this morning, that represents the core capability suite for us, if you will. So we find it extremely important that we put the client at the center of everything we do. We see your advisor as your key partner in this effort. And what we're trying to do is support that relationship with areas of expertise. Estate planning. We're going to dive into that a little bit today, and in part the second webinar that we're going to have, and we'll talk about that later today. We'll go deeper into estate planning specifically. We're pairing estate planning with tax planning. We think it's extremely important that we are there with you to help you make decisions relative to business structures, business ownership, real estate partnerships, complex, compensation plans that some of you have. And so we have tax team to help navigate tax complexities. We have insurance experts to help make sure that we're balancing the risk side of every client's balance sheet, if you will. We think a lot about legacy and how do we want to provide philanthropic advice, and charitable giving is super important to what it is that we do with you each and every day. And so legacy is a topic that will come up in the future for one of our webinars. And then, I think a lot of people think about a financial advisor and they think about the investments. And so that is something that you're well aware of and something that's core to what we do. And then core financial planning. And so when we talk about financial planning, want to take this to the next level. And so this next sort of picture, if you will, gives you a sense of some of the key areas of financial planning where we are partnering with our clients. And so some of these may be of interest to you and you have not yet, had the opportunity to talk to your advisor about these. And for others, this is probably a little bit of review because you've done this many times over. But goals-based investing is how we think about the world. And so what I mean by that is we really want to anchor to goals and outcomes that our clients are desiring and build a portfolio that supports getting to those goals or achieving a specific outcome. And so how do we do that? Well, we dive into estate planning. We dive into what we call wealth strategy and liquidity planning. We think it's really important to understand what is our net worth and what is that balance sheet for myself or my family or myself and a spouse look like. Consolidated reporting, making sure that we're taking into account all of your various accounts, whether that's just here at Miracle Mile and or if you have accounts elsewhere, so that we're giving you that full picture of what it is you have and how are those portfolios performing. We think it's really important to dive into risk management and how do we ensure that we're taking enough risk to help you achieve the goals that you have set forth, but also making sure we're not taking any unnecessary risk. Cash flow planning, especially as we start to think about and enter into retirement. We live this life, in this space where we have income and we have our paycheck, and however we might be getting those paychecks, then we all of a sudden cross this bridge into retirement. And how are we going to fund retirement? What is that paycheck going to look like? And where is it going to come from? And how are we going to do that in a tax efficient manner? And then ultimately, the last component is capital gains and income tax strategies. And this is where we bring the investment expertise paired with tax insights to make sure that we're building a portfolio that is efficient as possible for you. And so as we've highlighted and we've talked about, today we're going to spend some time focusing in the wealth strategy and planning area as it pertains to this estate and gift tax changes that are on the horizon. And so with that, Blake McKibben is our wealth strategist, if you will, by title. He is far from that formal of a human being, but he is a great human being, and he is an estate attorney. So Blake has been a practicing state attorney for a number of years. He has been at some of the biggest firms on the street in terms of financial advisor firms and banks. And so he has made a decision to join Miracle Mile Advisors in 2023 as our resident in-house estate attorney. And so we are really excited to tap into his experience and his insights as it pertains to the potential estate and gift tax law changes that are on the horizon. So thanks again for joining us. Blake, I'll turn it over to you.
Hey, thank you so much, Nate. And yes, thanks everyone for joining us here today. Now, before we begin, I just wanted to share a conversation that I had recently with a friend of mine that's a doctor. And he was just talking about how it's really interesting of how the same germs can impact individuals so much differently. And it made me think about our estate tax laws and really all of our tax laws, right? Is that everyone is subject to the same tax laws, but how it impacts our families is incredibly different one to the next. And so, over the next 20 minutes or so, we're going to spend time talking and doing a general overview of our federal estate, really our wealth transfer tax system. But really, we're just talking very general terms. But if you'd like, please reach out to your Miracle Mile advisor and we can sit down and have an appointment and get down in specifics about what it means for your family and how you might make some changes or updates to any plans that you might currently have in place. So on the agenda here today, we're going to look backwards and talk about our current estate tax laws. We're going to talk about how we got here, what happens next, and most importantly, some of the actions you can take today to leverage the current tax law as it exists. And so as we look at it here in 2024, we have an estate tax exemption of $13.61 million per person. Now, the estate tax exemption or the term exclusion can be interchanged. And the idea is that that's the amount that we pass away at death that we can shelter from the federal estate tax. Now, states may still impose their own state inheritance or estate tax, but I'm just going to focus on the federal level today. So the estate tax exemption, $13.61 per person. Now, also of note is the gift tax exemption or gift tax exclusion. It's the same dollar figure, $13.61 million. Now, you think about, well, what if anything is above and beyond that? Well, it's taxed at a 40% tax rate. However, there's one more gift exemption to think about out there, and we call that the annual exclusion gift. Now, that annual exclusion gift is one that is set at $18,000 per person per calendar year. Now, the use of that gift does not have any impacts one way or another on your gift tax exclusion or your estate tax exemption or exclusion. That $18,000 is unlimited per person per year. As long as you play by those rules, it doesn't have any impacts across the board. However, if you wanted to make a gift to somebody above and beyond $18,000, then what you'd do is you dip into your gift tax exemption. And what that will do is that will make it so that you make the gift while you're alive. You don't pay any gift tax on that. However, the use of the gift tax exclusion during lifetime directly impacts the remaining estate tax exemption or exclusion at death. Now, just want to show a quick example of what that means. So, for example, here we've got Beth, who made a gift to her daughter, May, in 2022. In 2022, she made a gift of $3.61 million to May. However, in 2024, Beth passed away. So when Beth passed away, she was worth, her whole entire estate was worth $20 million. The exclusion amount, as we talked about in 2024, is $13.61 million. However, that is reduced by that $3.61 million gift that Beth made while she was alive. And so her exclusion remaining at her death is $10 million. And so her estate that's subject to tax, 20 million minus 10 million, leaves 10 million subject to federal estate tax. At that federal estate tax rate of 40%, that leaves an estate tax of $4 million, meaning that at the end of the day, she passed away with 20 million, but net to heirs, net of that federal estate tax, will be $16 million. So that kind of sets the stage for what we have here. Now, let's shift more and talk about the system that we live under. And this estate and gift tax law, it really follows under what we call fiscal policy. Now, fiscal policies cannot be made permanent unless they are revenue neutral, meaning that any tax cuts that are provided for in the law have to be offset with corresponding tax increases. You've got the scales of justice there at the bottom. I'm a Libra, so that kind of makes sense. So as you can see, if it is balanced, tax cuts and tax increases are in line, it can be a permanent tax law. However, 3 of the last 4 estate and gift tax laws have provided for more tax cuts than tax increases. And because they've been imbalanced means that these tax laws have been temporary in nature. We just do a real quick history lesson, here in 2001, when George W. Bush took office, one of his platforms was he wanted to do away with the federal estate tax for good. And so in 2001, they passed a law, the Economic Growth and Tax Reconciliation Act, to be full for you. So the idea is this tax law, once again, it created this situation where it had too many tax cuts and not enough tax increases. It was a temporary law. That law expired because it was temporary. Once it expired, once again, another tax law was put into place that was 2 years in existence. Once again, it was temporary in nature because too many tax cuts, not enough tax increases. However, 2012, they passed the American Taxpayer Relief Act. This one was a permanent tax law because it was able to balance the increases and the cuts. However, that was supplanted in 2017 with the Tax Cuts and Jobs Act that once again created this imbalance with too many tax cuts and not enough tax increases. Now, will history repeat itself? Well, this is interesting. This is really important for us to look at. So this the original tax law here that was put forth in the Bush presidency, right? That law was passed in June of his first year in 2001. It was effective from 2002 to 2010. And you think, well, geez, that was a long time that law was in existence. And Congress thought, hey, you know what? We'll pass this law. Everyone will get behind it, and we'll find a way to make this thing permanent. Well, guess what? It never happened. And the law was set to expire 12/31 of 2010. However, they didn't get their act together until 2 weeks before the expiration of that tax law. So it was signed the 17th of December in 2010. Talk about waiting to the last moment. Well, I just want to put this in context for you. And I don't know if you've ever heard the analogy before. You take the entire history of the world and you put it on a 24-hour clock. If you look at that, dinosaurs didn't come into existence until 11 p.m., right? In the 23rd hour. We humans have only been around for the last 15 seconds or so of time. So if you think about this in this tax law, right? So it was effective from January 1, 2002 until the end of December 2010. That means that they waited until that December 17th date. That was essentially putting that in a 24-hour clock. They waited until 7 minutes to midnight in order to pass that tax law. So they waited almost until the very last moment in order to do that. Well, as I said, the 2010 law was also temporary in nature. And guess what? The same thing happened, although this time they let the clock run out. And so this new tax law wasn't actually signed until January 1st of 2013. So we actually had a 2-day retroactive tax law. And so in the end, it was like they passed it at 12:04 a.m., right? So we have this in the past, this track record of we've got a temporary tax law. We know that it's going to expire. However, there was no political will or compromise in order to get things done before the last second. And now we have again the stage set with the Tax Cuts and Jobs Act that is set to expire at the end of 2025. How much time will be left on the clock this time? I have no idea. I tell you, a lot really hinges on what's going on in courtrooms and of course the election and things like that. But going back to it, I really believe that history will repeat itself, and we're probably not going to see what will happen in 2026 until December of 2025. I hope I'm wrong, but I'm just being realistic here. So what happens in 2026? Well, here's the way that the law is set up. So remember, in 2012, they passed a law that was permanent in nature. So that tax law harkened back to, it had a $5 million exemption per person with a tax rate of that 40%. And so what happened in 2018 for 2017's tax law is they doubled that exemption. And so what happens is then we keep going on this route, and the exemption is adjusted for inflation every year. And so here in 2024, 13.61, 2025, somewhere around 14 million. But in 2026, what happens is we revert back to the last permanent tax law with that $5 million exemption scaled for inflation. So if this tax law expires, we're left with around a $7 million exemption per person. Now, thinking, well, hey, the exemptions are high now. What if they go down in the future? Well, can action be taken? Can I utilize my gift tax exemption today while these exemptions are high? Well, yes. The IRS has promulgated what we have dubbed the anti-clawback rule. And here's a picture of it. This is the proclamation in the Federal Registry right here. And what this rule ensures is that individuals won't face penalties if they utilize more of their exemptions during their lifetime than what exists at the time of their death. And so, in essence, what the IRS is supporting is a use it or lose it type of a strategy. So, how can we use it? Well, it's by making a completed gift. Now, there's a lot of things to think about here, because a completed gift, it must be irrevocable, meaning you can't change your mind and reacquire the assets in the future. A tough one is, in order to make that gift completed, you have to relinquish all control over those gifted assets. And most importantly, you have to relinquish all of the benefits over these assets. So when we're looking at this, we're thinking about this, we really have to be careful because the exemptions are high, but we have to do some really careful planning and some important analysis to make sure that whatever gifts that you utilize today are not going to impact your future flexibility. And so as we look at that and how we can utilize our gift amount while we're alive, here's a spectrum of what we've created as possible wealth strategies that can be used out there. So there's different colors, family and charity strategies. But this is really a risk and reward type of a graph here. I'm going to highlight two of these today. Of course, every family is different and it might be different for, this and that, but I'm going to talk about two important ones today. The Irrevocable Dynasty Trust and also the Spousal Lifetime Access Trust. Because I think these are two of the most common vehicles that we're going to be seeing employed for families to utilize this exemption. And so as we look at a dynasty or generation skipping trust, the idea is that here, typically it's where parents are creating a trust for their child. However, it could be individuals setting up a trust for their siblings, their friends, their family members, anything like that. So the way that these trusts typically work is that assets are gifted into that trust, and then that trust will live on and create this distribution for the beneficiaries' health, education, maintenance, and support. Now, those four words are kind of, they're very gray, and they're very gray for a reason. We use that in the estate planning community is because that is what is recognized by the court system as we call it the ascertainable standard. So that is the grayest that you can define a beneficiary's access to funds, but still provide protection from the beneficiary's creditors for the assets that are in that trust. So one of the nice benefits, yes, you're going to utilize your high exemption today, but the other benefit is whatever is in that trust is going to be outside your taxable estate, and it's going to be outside the reach of your beneficiary's creditors as well. Now, the neat thing about a generation skipping trust or a dynasty trust, if this is done appropriately, when the beneficiary of that trust dies, whatever's left in that trust is not includable in that beneficiary's estate for estate tax purposes. Now, this can be even compounded if you decide to create a trust in a state that has repealed the rule against perpetuities, meaning that in states that have repealed that rule means that trust can live on forever. If you live in a state that has not repealed that rule against perpetuities, well, then the trust can typically live on for about 90 years in time. So as we think about the most bang for the buck, as we look at utilizing our exemptions and shielding assets from estate taxes today and maybe into the future, is going to be a dynasty or a generation skipping trust. But that caveat comes back. Geez, whatever I give in there, I lose control. I lose all benefit over those assets. Well, that leads me to my next concept that I want to talk about. And that's what we call a spousal lifetime access trust, or a SLAT, as it's called. This is a trust that one spouse creates for the other. Now, they can each do a trust for each other. So it's not just a one-way street. It can be both ways. Now, the idea here, very similar. You're creating this trust for your spouse and for your children if you'd like to add them in. And so while your spouse and your children are alive, they get distributions for health, education, maintenance, and support, those four magic words. The nice thing about this is that indirectly, the grantor, the spouse who created the trust, indirectly gets to benefit because their spouse, who's the beneficiary, gets to benefit from the trust for their health, education, maintenance, and support. Well, maintenance and support, we think about, well, that means keeping the roof over their head and paying some household expenses and things like that. So this is a type of a trust that it kind of allows you to have your cake and eat it too. You can utilize your full exemption through this type of a trust, but in some way, at least your spouse is the primary beneficiary, and they'll be able to benefit from it. But the grantor, the creator of it, will also indirectly be able to benefit from it as well. Now, if done correctly, this also can help avoid it. So these assets are outside of the grantors, the creator of the trust estate for estate tax purposes, but they're also outside of your spouses, the beneficiary of the trust estate at their death as well. Properly structured, then the spouse passes away, it goes to the children or whoever is the next beneficiary, distributes to them for health, education, maintenance, and support as long as they're alive. And then if done in a proper state at their death, can continue to go on and on and on, generation by generation, avoiding estate tax inclusion along the way. And so there's a myriad of different solutions and strategies that we can talk through and help your family with. But I just wanted to highlight these two as they are probably the most prevalent of what I have seen. Well, I was practicing in 2010 and 2012 again, where we had these cliff tax years, just like next year is going to be in 2025. Let me say this, is that creating these structures, whatever type of a trust or thing it is, that's the hard part. So creating the trust is the hard part. Now, funding it is the easy part. And so my advice to any of you listening here is that if you're thinking about any of these concepts or utilizing your exemption while you're alive to make gifts, it's best to get on the planning wagon sooner rather than later. When I was in 2010 and 2012, if you tried to get into an attorney's office in the fourth quarter before these tax laws were going to expire, it couldn't be done because the attorneys were too busy drafting and drafting and drafting and drafting. And so my advice is start this process. Let's have the conversation and then utilize and work with your attorney to put some of these trusts in place. Now, important to note is that, drafting the trust takes time, but funding the trust can be done at the stroke of a pen. And so what we see a lot of times is the recommendation is let's create the trust and let's let the trust just sit there. And when we know more as the years go on and we find out what happens in the election in 2025, then we can decide we can fund the trust at that time. So that's the recommendation. Start now, because if you wait too long, it might be too long in waiting. And so once again, I just want to thank everyone for the time that you've spent with us here today. Now, we have another in our series here in just a few months in the end of June, where we're going to talk about estate planning and all of the foundational documents, how we coordinate everything together to make sure that your goals are met and you're going to benefit who you want, when you want, and how you want.
Blake,
Nate,
Blake, this is fantastic. I do want to ask one question because if I'm, sitting here and I have my financial advisor, I have a CPA, I have an attorney that has done maybe a will, a trust, an estate plan in the past, maybe it's the distant past, and I'm sitting here listening to you saying, gosh, I'd like to review either one of these components that I just mentioned, but there's all these people involved. Maybe you could just speak to how it is that you partner with the financial advisor and the client in a way that is actually supportive of the CPA and attorney that they've been working with in the past, and maybe it actually helps in terms of the overall coordination of efforts in your engagement. Maybe you could just speak to that.
Yeah, thank you for that question. And yeah, it's really important to note. I am part of the Miracle Mile team. I'm here to supplement your attorney, not supplant your attorney. And so we at Miracle Mile are here to help you coordinate and quarterback the process from soup to nuts. And so a lot of times what I do for our families is I will review current wills and trusts and things like that to help our clients understand what it is that we're starting from. And then I help to brainstorm ideas on what's possible, and given your goals and your wishes, here's what we might suggest that you and your attorney put into place. Now, what I can do as well after that is, and the way that I work very well with attorneys is I just help facilitate. When I was drafting documents, the hardest thing for me to get from my clients was a list of who are the important people, what's their contact information, who do you want to serve as trustee, power of attorney, executor, and things like that. And so that's what I help my clients to do is think about who these people are, these important roles, and really what, help understand, first of all, what those duties are and to help you pick the right people. But that way you become more organized in your thinking. And so when you go and you go to your attorney's office, you're going to be able to hand over a list and say, hey, these are the people that I want in these important roles. So we're going to save a lot of time, and we're going to save a lot of money, quite frankly, with your local advisor. And in the end, I've worked with, for the last 17 years in roles like this, where I've, worked with clients' attorneys to help update and implement estate plans. And I often find a great appreciation from the attorneys. I was thinking about just a few months ago, meeting with an attorney, and he said, I've been talking about this concept with my clients for 5 years, and finally today they're doing it. And he was like, thank you, because, and it just came down to, the background. The clients just didn't quite understand what the concept was. And so that's my job as well, of just helping everyone to understand what these concepts are, what they do, in order for you to have that confidence to say, that's what is right for my family, and that's what I want to put in place.
That's fantastic. So Blake, thank you again for your insights this morning. We have a couple of questions that have come in, and I think a couple of these are very detail oriented that we probably want to take with specific answers back to the people that asked the question. And so before we hang up, we will address a couple of these. Number one, if you have specific questions, please send us an email at info@miraclemileadvisors.com, or reach out to your financial advisor and we will get you connected directly with Blake. And again, the email address for specific questions, info@miraclemileadvisors.com. One question that came in here says, I am assuming that a SLAT would still be an option if one spouse is deceased. Can you speak to how it would be different at all once that spouse is deceased?
Yeah, that's a good question, and unfortunately, in that case, what you would do is, instead of creating a SLAT, you would create a dynasty or a generation skipping, or just an irrevocable trust for the benefit of your children, because a SLAT really is for a spouse and a living spouse. And so, in that scenario, we would just forego the spousal lifetime access, the SLAT, and create just an irrevocable trust for the benefit of children.
Great. I think the other question, there's a question that came up here relative to estate tax attorney costs, and I think that is a question that is a broad range depending on who the estate attorney is, where you live. And so what I would recommend doing is having a conversation or send that to us in an email so we know who you are and where you live. And if you don't have one, we're happy to make, a recommendation. And I think that's a really important point for us to note here. Blake, as our in-house estate attorney, is a part of the advice that we want to be supporting you and that financial advisor with. And so we're happy to have a conversation, and then we can dive into sort of your scenario to talk through what an estimated cost might be based on how complex and what type of documents, are being considered for your specific situation. So again,
Yes.
some of these that are specific, please send us an email. We're happy to circle back with you.
Yeah, and I'll just add
Oh, go
real
ahead.
quick, Nate, is that that yes, it's going to be depending upon your sophistication and where you live, but also the timing of it. We didn't have a tax law change in 2020 with the presidential election. However, there were a lot of people that were trying to do some planning right before the end of that 2020, before Biden was actually sworn in. And at that time was another time of frenzy at law offices. And I know at least one law firm that was charging a $40,000 retainer just to pick up the phone or answer an email for clients on potential planning. So once again, it just goes to the fact that with all these potential changes in the future, time is of the essence, and important to start the process sooner rather than later.
So Blake, I'm going to tee up one last question for you while I answer one, and then we'll wrap it up because we want to be sensitive to everybody's time here this morning. For a married couple, is it better to use all of one spouse's estate tax exemption or use a portion of both? So you think on that. There was a tactical question that I can answer that comes in regarding, does Miracle Mile provide estate tax services, or do we have to go elsewhere? So our goal is to partner with you to do the bulk of the planning work. And so while Blake isn't a practicing estate attorney, we are not a law firm that actually drafts the documents, but we will sit down and give you an entire plan. We will help you collect and organize all the data and information that estate attorney would need to do the final drafting of those documents. And we're also happy to actually engage with that attorney in partnership with you if that's something that helps you feel more comfortable in that process. And so Blake, I'll hand it over to you for the final question, and then we'll wrap up.
Yeah, and I just want to add something to your last comment, Nate. And that another way that we serve our attorneys that we work with is, when making these decisions, it's really important because they're irrevocable, that there's some science and there's some planning behind it. And so, attorneys will draft documents and they're great at drafting documents. However, we are really good at financial planning and retirement planning. And so we can put the numbers behind these decisions to give you the confidence that yes, what these tools that we're putting into place, that you will maintain your flexibility for the future. And then Nate, you're going to have to remind me of that first question again, because you didn't say at the beginning, but I've had some head trauma in the past that I need a little help remembering.
Football in Iowa will do that to you. For a married couple, is it better to use all of one spouse's estate tax exemption or use a portion of both?
Great. Okay. Great question. And I have to be honest, the answer is it depends. There's a lot of variables here. One of the variables is, the idea of when you make a gift while you're alive, your basis that you have in that property carries over to the person who you make the gift to. And so if you are creating a trust and you're funding it with assets with a very low basis, well, we got to think, because that carryover in basis will stick in an irrevocable trust. So when the assets are in the trust and they then are sold or diversified or something, the trust is going to have a big capital gain on those appreciation of those assets. However, if you wait and you pass on something after you've died, we have what's called a step up in basis. And so your basis in your assets die with you, and your children or whoever your heirs are will inherit those assets at the fair market value will be set as the basis. And so it depends on what type of assets that you have that you might be funding this trust with. There's some other terms in the trust as well that add some wiggle room and things like that. But at the end of the day, there's kind of a break-even point of, you know, just using a portion of the gift, you know, that might be overwhelmed with the step up in basis. I think that it's around $10 million. If you use about $10 million of your exemption, you're going to be able to utilize and get enough bang for the buck, even without step up in basis. However, I'll just come back to, it just depends on your circumstances, the assets, and you know what your end all goals are. So.
Wonderful, Blake. Again, thank you all for your time this morning or this afternoon, wherever you are. It's truly a privilege for us to spend this time with you, to be a partner with you in life's journey. And if you need anything from us, please, again, reach out to your advisor or reach out to info@miraclemileadvisors.com. We will gladly respond to you with an email, and or we're happy to get on the phone or Zoom and engage you how you see fit. If any of you have specific questions that we didn't have a chance to get to, send those in to info@miraclemileadvisors.com. We will send you replies or responses to your questions. If you're interested in some of these slides, you can send us a request as well, and we will get these approved and sent over to you for your review as well. So thanks again, Blake. Thank you for sharing your insights and your expertise. We look forward to hopefully seeing some of you on June 27th as we dive into legacy planning and the importance of carrying on your legacy beyond yourself and for generations to come. And so we look forward to that conversation. Until then, take care. Talk to you soon.